In short, RSUs are taxed when they vest, ISOs, possible tax advantages, not a little more complex, and NSOs are taxed when they're exercised. Knowing which one you have is step one. Then note what those key dates are, your grant dates, vesting, exercise. Become familiar with what those dates are and what those dates even mean and how does that apply to the stock option that you have. And the role of timing. So when it comes to equity compensation, which is what we're talking about, stock, they're kind of paying you in, equity compensation, timing isn't just about the calendar, it's about how long you hold those shares and when the taxable event occurs. So for example, RSUs are pretty simple. The taxable event happens automatically when they vest. But with ISOs and NSOs, you kind of control when to exercise those, and your timing determines whether you pay ordinary income tax or capital gains tax. So we want to always pay the least amount of taxes that we can. Here's an example. If your company has stock price that's maybe gone up since you were granted your options and you're exercising your ISOs and holding them long enough, that could qualify you for long-term capital gains, which is a lower tax rate. But if you sell too soon, all of that's going to become ordinary income. That's why planning before year end can make a real difference. It's about understanding when to act or sometimes when not to act. So here are a few common mistakes to avoid. I'll give you the three most common ones that we see professionals make with company stock. One is ignoring those vesting and expiration dates, letting options expire, or being surprised by when their RSUs vest. Number two, selling without understanding your cost basis, which can lead to overpaying in taxes. And number three, not coordinating with your CPA, which can lead to big tax bills in April that maybe you could have avoided. So all of these with a little preparation are things that you can prepare for and maybe help you have a little less headaches later.